How's it guys? Welcome back to Aspire's YouTube channel. Today we're going to be doing From the Ground Up episode 5 with a little bit of Forex terminology. Let's get right into it. So when it comes to a pip, otherwise known as a point in percentage, that's the unit of measurement in Forex to show the difference of value in between the two currencies.
So there's usually two different prices on currency pairs, and this is going to be the bid and the asking price. When it comes to spread, we have two different prices. You have the bid price as well as also the ask price. So the bid price is where you can sell that base currency, and the ask price is where you can buy that currency. So the difference between the bid and the ask price is spread, and this is what the broker earns as a commission.
So when it comes to leverage in hopes not to overcomplicate it, it's defined as your buying power within the market. So the more buying power that you have, obviously the more money you can make, but when it comes to leverage as well, it can also be risky as it can end up in you practicing bad risk management.
So margin can be defined simply as the amount required to open a trade. The margin goes hand in hand with leverage, so the higher the leverage chosen, the higher the margin will be as well.
So obviously, as you guys know, when it comes to pending orders, we can't physically be behind our laptops or computers 24 hours a day looking for setups. So what pending orders are, they are basically an order set at a predetermined level. So when price touches that level, it activates your order.
Long is simply just another way of saying buy, so it's a fancy way of buying a currency pair.
So yeah, the same goes for short. It's just a fancy way of saying sell. Like Ewan said, it's a fancy way of saying that you're selling a currency pair.
Next we have a buy limit. So this order is placed below price in hopes that it will reach this level and then it will be activated once reached to then continue higher.
So basically what a sell limit is, it's when your order is placed above price in hopes that when price reaches that level, it will then continue falling from that price.
So a buy stop, this is when your order is placed above price in hopes that it will reach this level and then continue going even higher.
So a sell stop, this is when your order is placed below price in hopes that when it hits that price, it will continue to go down.
So take profit, this is a predetermined level at which your trade will then be closed in profit.
So when it comes to your stop loss, this is a predetermined level that if your trade hits that level, your trade is closed automatically. This predetermined level can also be put into profit when your trade is running in profit. So when your trade turns around and comes to knock you out, at least you're knocked out in profit.
So similar to what Liam just mentioned, where you can move your stop loss into profit, you also have trailing stops, and this is used when your trade is running positive. Your stop loss then moves a certain amount of pips in that direction as well. If you are up 20 pips and your trailing stop loss is 10 pips, you will then immediately go 10 pips into profit.
Support can be defined as a zone which price is failing or struggling to break below. Sometimes support is also seen as the floor of the market. So if you're looking at a house, the roof and the floor, support is normally seen as the floor. If you throw a tennis ball against the floor, it normally bounces off of the floor.
So resistance can also be defined as a level which price is struggling to break above. Similar to the house example, this is the ceiling in price.
So that's it for today when it comes to terminology. Thanks so much for listening. Please don't forget to like and subscribe and drop a comment in the comment section below.